Hey guys, welcome to the 10X Academy. I am your host JR, and in today's video, I will be focusing on ETFs versus stocks for your investment portfolio and how you can determine what investment strategy is best for you. I will also be discussing how you can create a passive dividend income producing portfolio that fits your needs and goals for retirement. Stay tuned to the end of the video where I will provide 2 simple investment portfolio strategies you can start using today to start your path toward financial independence. ETFs, or exchange traded funds, are investment funds traded on the stock exchanges, much like stocks. ETFs hold assets such as stocks, bonds, or commodities and generally operate with an arbitrage mechanism designed to keep them tracking close to their net asset value. Investors can use ETFs to establish low-cost, well-diversified portfolios of stocks, bonds, and other assets. The key is to understand how the relative advantages of ETFs correspond to an investor's priorities. ETFs have numerous pros, which include diversification. ETFs provide a diversified portfolio of assets as broad or tailored as desired. ETFs can consist of a distribution of a few dozen to even hundreds or thousands of stocks, bonds, or other commodities. Low cost. ETFs provide a relatively low cost versus purchasing individual stocks. Instead of paying individual commissions for stock purchases, ETFs carry an expense ratio which is paid yearly. The average ETF carries an expense ratio of 0.44%, which means the fund will cost you $4.40 in annual fees for every $1,000 you invest. Reduced risk. They provide more minimized risk due to diversification for a large-sized ETF. For broader ETFs that cover the entire market and contain several hundred or even thousands of stocks and bonds, diversification reduces volatility to any one or handful of stocks and provides safer and reduced risk exposure. Customization. ETFs are tailored for different target allocation. For example, a high dividend yield ETF or a low volatility ETF, or even a sector-specific ETF, such as a utility sector ETF. Customized ETFs allow an investor to handcraft a broad portfolio with diversification in mind while reducing risk and obtaining maximum exposure to the market for sustained growth and appreciation. Liquidity. ETFs can be bought and sold just like stocks through a brokerage and on the open market. Leverage. ETFs allow investors to have access to higher priced stocks such as Amazon or Alphabet for a fraction of the price by providing exposure to these companies through the ETF itself. ETF cons. Diversification. Although diversification is great for ETFs, some customized ETFs may be limited in exposure to smaller cap stocks due to a limited group of equities in the market index, so they may be forced to hold only large cap stocks, thus reducing growth opportunities for the fund and the investor. Growth factor. Although ETFs provide many benefits versus individual stocks, ETFs that are more diversified may reduce growth opportunities versus a portfolio consisting more of individual growth stocks. This is simply due to having shares of an ETF, which is an average of several hundred or even thousands of stocks, versus shares of individual stocks which could appreciate higher and give higher returns. Lower yields. Dividend-paying ETFs yield returns are typically lower than owning a portfolio consisting of a group of high-yielding individual stocks. This is again due to the averaging effect of a variety of different dividend yields versus an investor being able to craft and customize their portfolio to higher dividend-paying stocks of choice. As an investor, you must ask yourself, what are your priorities? Additional questions that you would have to ask yourself are, what is your time frame for investing? Are you looking to invest for a longer time frame, say 20 to 40 years, or more shorter time frame based on your goals and needs? What are your reasons for investing? Is this for retirement or other goals such as a home, a car, or just extra cash? How much capital do you have to invest? And are you able to make regular contributions to grow your investment? Are you looking more for capital appreciation or recurring dividend income that gets paid monthly? As an investor, there are several methods of investing. Investing for growth versus dividend income is often a choice that has to be made up front. And finally, and more importantly, How much capital will you need at your end goal date to be able to meet your target? Setting your target and reverse engineering your income goal is crucial to devising a plan for hitting that target. Once you set your target, figure out how much you need to invest and what kind of return on investment is required to achieve and hit that target. For example, let's say you need $1.2 million in 25 years, and you establish that your goals will be met with this amount and you can comfortably live off that amount for the subsequent X number of years. Based on this goal and an average rate of return of 8% per year, which is the average rate of return of the S&P 500 index for the last 90 years, you would need the following: a well-diversified portfolio of ETFs and individual stocks that would average an 8% rate of return while contributing approximately $1,250 per month for 25 years. This portfolio can be constructed from dividend-paying ETFs and growth stocks, or a number of different ETFs and individual stocks with customized allocations of the different asset classes, market capitalization, and sector diversification to meet your required goals. An example of a diversified portfolio that meets all the requirements of diversification across asset class, global, sector, as well as market cap is shown here. This portfolio includes the following funds: VYMI, the Vanguard International High Dividend Yield ETF. This has a dividend of 3.82%. Noble, ProShares S&P 500 Dividend Aristocrats ETF, and this has a dividend of 1.47%. DON, D-O-N, this is the Wisdom Tree US Mid-Cap Dividend ETF, and this has a dividend yield of 5.84%. DES, it's the Wisdom Tree US Small Cap Dividend ETF, and this has a dividend of 7.42% yield. DLS, this is the Wisdom Tree International Small Cap Dividend ETF, and this has a yield of 2.32%. And finally, DIM, the Wisdom Tree International Mid Cap Dividend ETF, and this has a dividend yield of 2.57%. This diversified portfolio generates an average dividend yield of 3.54% and is fully diversified based on our criteria, with minimal risk and maximum returns potential. If you're interested in using this portfolio, click on the link in the description for the exact portfolio to start investing. Another portfolio that contains more growth components and a mixture of stocks and ETFs is shown here. This portfolio consists of 4 individual growth stocks: Visa, Microsoft, Amazon, and Google, as well as the VTI ETF, the Vanguard Total Stock Market ETF, for more exposure to the growth sector of the total market. Between the ETF and the individual stocks, this constitutes 40% of the portfolio. The portfolio also contains exposure to dividend income producing stocks that are stable and have a long history of dividend payouts. These include Starbucks, PepsiCo, Procter & Gamble, McDonald's, Kimberly-Clark, Johnson & Johnson, Duke Energy, Clorox, 3M, and Coca-Cola. Along with these individual stocks, adding VYM, the Vanguard High Dividend Yield ETF, gives the investor added exposure to more high dividend yield paying companies. All of these combined constitute 50% of the portfolio. The remaining 10% of the portfolio consists of BND, the Vanguard Total Bond Market ETF, which provides a fixed income 2.82% bond yield for stability. The total dividend yield for the entire portfolio is 2.24%, but the growth positions added to the portfolio produces an additional capital appreciation which yielded 84% in the last 5 years, or an average of 17% per year appreciation. But taking the conservative estimate of 8% returns mentioned previously, a generous 10% average rate of return from this portfolio can be achieved. Be sure to check out the links in the description for these 2 done-for-you portfolios, which you can start using today to invest to start your path toward retirement or financial independence, whatever your goals may be. Time in the market versus trying to time the market is key in investing. Invest for the long term and compound ROI, or return on investment, which is basically the appreciation of the stocks and the dividends paid out, reinvested. Continue to invest capital on a regular basis using dollar cost averaging to make your portfolio grow over time. The ideal appreciation curve of your portfolio over time should look like this. Be sure you understand the differences between ETFs and stocks and how you can use and leverage each to build your investment portfolio into a dividend income producing asset that will allow you to achieve financial freedom. Also, be sure to check out the links in the description for your done-for-you portfolios so you can start investing right away. Thank you for watching this video. Don't forget to hit that subscribe button and smash that like. You will be supporting this channel and the financial independence retire early movement.